Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today, I have the pleasure of welcoming Annie Dickerson and Julie Lamb with Goodegg Investments. Welcome to the show, ladies.
Thanks so much for having us.
Thank you for taking time. Both of them busy moms with corporate careers, and they have successfully transitioned into real estate. And I have the pleasure of speaking to them today and dig into their story and learn interesting things as to what they have done. They are a big force right now, raising capital and equity for a lot of successful operators that we all mutually know. And I was very excited to learn about their story, and it's very inspiring for everyone to hear how they have been able to add such a tremendous value to a lot of passive investors, educating them and raising equity and capital, and at the same time giving a lot of good returns and multiplying passive investors' money. It is very inspiring, and a lot of investors should take a note of the work they are doing, and it is very inspiring, as I said. So welcome to the show, ladies. It is my pleasure to host you today. Let's get started. If you can both kindly give me some background on what your previous experiences were and how you got and married into Goodegg Investments as a company now. You want to go ahead with first, Julie there?
Sure. Yeah. Hi, I'm Julie Lamb. Thanks so much for having me on the show today. So I got started in real estate investing back in 2009. And I was just doing, the traditional narrative that people do when they get married, which is buy a home, because that's how we're taught to build our wealth, right? Mm-hmm. And it just so happened that it was 2009 and that the property we were looking at buying was, 50% off of what it was a year and a half prior. And we thought, well, maybe one day, this property will be worth what it was a year or two ago. And, as the market cycle started to mature, that's pretty much what started to happen. I live in San Francisco. And so that's some of the surrounding areas outside of San Francisco were kind of hit pretty hard in the downturn. And so that was kind of an opportunity for us. We bought that property. It was like a 3-bedroom house. And we ended up doing what we call in the real estate industry house hacking, which is where you rent out the other rooms to offset your debt payments. And that's what we did. And that was sort of when the light bulb went on, in terms of, leverage and building wealth. And that was when, real estate started becoming more interesting from an investor standpoint. We started buying more properties in 09 and 10, and then we started to exit those properties in 13 and 16. And, we were trying to figure out what the next best move for us would be. And I thought, maybe the best thing for us to do would be to get into more debt and, buy a primary home, which is what I think most people do, right? As they grow in their careers and they have more money, they think I'll get myself into more debt. And as we were moving through that process, I realized very quickly that that was not the way to build wealth. It just could not be. And as we were facing this huge mortgage, I couldn't imagine working the next 30 years of my life, if I even made it that far, to pay down this mortgage to own this house. And so that's when I discovered cash flowing rentals out of state around that same time. We didn't buy the house, and I started buying properties out of state for cash flow. And that was when another light bulb went on, to be able to park my money in an investment and have it pay me instead of the other way around where I park my money in a primary home and I have to pay it. And so that was when kind of another light bulb went on, and I knew I wanted to do more of that. But the the work that goes into, as I'm sure the work that goes into buying single family homes and smaller duplexes, it's a lot of work. Especially every property you buy, you have to work with a lender, and there's insurance and all kinds of things. And so that was when I wanted to get into multifamily because I thought, if I can do 200 or 300 doors at once with potentially the same amount of work, then it might, start to make sense in terms of potentially financial freedom. And so that's how I got into multifamily. As I started to research multifamily, though, I quickly realized that there's a lot of moving pieces that goes into acquiring a building, everything from underwriting to capital raising to asset managing to working with lenders and building broker relationships. And so I found out about that opportunity to be a passive investor around that same time, and I didn't even know about that. And I thought, this is interesting because now I can get into a deal, I can learn about the deal and the opportunities and learn about the markets, why we're investing there, and essentially get paid to learn, right? So I can, instead of putting my money into a deal and potentially putting myself at risk because I don't know what I don't know yet, I can leverage the knowledge and expertise and relationships that other more experienced operators have in markets that I'm interested in investing in while I'm earning a return. And so that was really interesting for me. And that was when, again, another light bulb went on of, wow, I can put money here after I, of course, did due diligence. I can put money here and earn a return monthly into my bank account for doing nothing. And so that was when another light bulb went on. And that was sort of the beginning of my capital raising career and doing what we do now at Goodegg Investments. And in 2017, I was offered the opportunity to do my first capital raise and did a few of those before I met my business partner. And in 2018, and then we co-founded Goodegg Investments together, and we, over the last year and a half or so together, we've done about 13 deals. So yeah, that's kind of the long short story on my background.
That's awesome. And how about you, Annie?
Well, it's funny, Julie mentioned that we didn't meet until about a year ago, and it's funny how parallel our paths have been. So I'll spare you of hearing the same story twice, but basically we started out the same way. My husband and I bought a duplex when we first got married, and then we house hacked that one, and then we bought another few duplexes. And now we live in the very expensive San Francisco Bay Area. So then we started investing out of state, just like Julie did, and quickly found out that that's much more work than we had anticipated. And so one thing led to another, and we became passive investors as well. And so it's funny, so Julie and I met a year ago, and one of the passions that we had was we were both interested as busy working moms in helping other busy working moms to learn about passive income and the transformation that it could have on their lives as it had on ours. And so that's how the conversation that we initially struck up was around helping other moms. And then over time, then we said, hey, we're trying to help the same people. Maybe we could join forces. And that's how the partnership was created.
That's awesome. That's awesome. And it's very interesting. You both mentioned that I had the same parallels. We own well over 200 properties now, but I can relate to exactly what you're saying, is that being in a very expensive market and trying to invest out of state adds such a ton of a level of complications that it's not, it is a very active business that you have to be very connected to understand what's happening, have a very good property manager and things like that. So there's a lot more to it than just seeing just a pro forma or a property and just saying, okay, this works, but not realizing that come month 3, 4, 6 down the line, you may have an eviction or an expensive repairs and things like that. And those things tend to be sort of the pitfalls for a lot of investors. But awesome.
Yeah, absolutely. I'll just throw in a quick story here, because we had house hacked a number of duplexes, and we thought, we got this. We could do this whole out-of-state real estate investing thing. That's no problem. We've read all the Bigger Pockets forums and listened to the podcast. We have our own homegrown spreadsheet. We know how to analyze these deals. And on paper, the out-of-state rentals that we bought cash flowed great. Hundreds of dollars a month each for each door.
Until
this is going to be great. So we bought several, we quickly amassed a couple dozen units out of state. And then all of a sudden things started going wrong, and I think the thing was when we house hack, we're attracting tenants like ourselves. They have full-time jobs. They pay on time. They let us know if there are maintenance issues. Sure. But when we are investing out of state, we're following the guidelines. We're investing in these developing areas. And so we're attracting a very different tenant profile. And with that comes very different problems. Absolutely. So that's something that both Julie and I have learned the hard way.
Yeah. No, and absolutely. And I mean, you come across so many sort of unreasonable requests and things like that, we deal those such issues on a daily basis. We have our staff who's highly capable to tackle these things. But I can imagine that, being out of state, trying to tackle these investments can be extremely difficult, and to make things even worse, if you don't have a competent property manager, it can really complicate things for sure.
Yeah. Awesome. And it's hard to tell from afar how competent they actually are sometimes.
And that brings into full circle as to why multifamily and large deals and how passive investors can be leveraged and their capital can be utilized so that we can give them the returns and things like that. I mean, I cannot begin to tell you, over the years of my career, I met so many people that I was trying to help, but I think single family in general doesn't lend itself to a lot of these passive investments unless you do some kind of a partnership or a joint venture and things like that. But the bigger deals, which we are going to get into, those are the ones I believe are the right vehicles and the right size, so that multiple investors can come in and buy a larger asset, as we technically call using syndications. So give us a quick story on your Goodegg Investments, what you both are involved, how you sort of help the passive investors. Just give us a rundown on how everything came about.
Well, I think a big part of why we got together was, there's so many different parts of syndicating a large deal, right?
Sure.
You have to have the relationships with the brokers, you have to look at the properties, analyze the numbers, and then you have to raise the capital, close the deal, manage the asset. So there's so many different pieces. And the piece that Julie and I gravitated toward was raising capital.
Sure.
But even within raising capital, there's still a lot to do. And so the two main parts that we have identified are, one, the education piece, and second, then once you're educated as a passive investor, how do you actually invest in the deal and how do you connect with those deals? Sure. That's why we came together. Is I sort of take the lead on the education side. So when a passive investor comes to us and they say, well, I want to invest in a deal with you, but I don't really know the difference between a cap rate and an equity multiple. I don't even know what those words mean.
Absolutely.
So they come to us and we have lots of blogs and videos and resources and an online course to really help them get from having no experience with real estate investing to a point where they can speak the language, they understand how to look at a deal, what the pitfalls to look for, all of that, whether they invest with us or not. So that's the first thing we provide, is the education. And then once they're ready to invest, then Julie is with them every step of the way. And that's really her strong suit, is in helping investors think through their investing goals and their investing strategy, and then helping them to connect with the right deals for them.
Awesome. I love your work. And Annie, I think few things I can say is that confidence through education is such a powerful thing that once you educate them and they are confident, I think they can ask all kinds of problematic questions to Julie and make her life difficult, isn't it, Julie?
Yeah, that's right.
So I appreciate the detailed answer there, Annie. So speaking about, evaluating some of the investments and, who are the people doing those investments, we call sponsors or operators and things like that. So give us an overview there, Julie, as to, what goes behind the scenes that someone contacts you that, hey, I think we have an investment. Give us that process rundown as to how you evaluate, what sort of questions you are asking the operators. Sometimes it's not just the deal itself, as you can relate, it's their integrity, their track record and things like that. If you could give us some overview on how is your sort of process to evaluate, that'd be great.
Sure. Yeah. So I would say that, in terms of, building a relationship with the operators, it's one that we don't take lightly. We initially started out working with one operator, and I would say that one operator that we identified as a solid operator, strong track record, integrity, and sort of, checked all the boxes for us. Sure. We've done about 80-90% of our deals with that one operator. So that's that gives awesome. Kind of an idea of the way we like to work. What we don't want to do is have, 20 different operators in one deal with each operator, because in our opinion, that doesn't allow us to build the strong relationship that I believe is required, to do the partnerships and the deals that we do together.
Completely agree with you there.
Yeah. And so anyone that we've partnered up with, and we only have 4 operators that we've partnered up with across all of the deals, is, somebody that we've known for a while. So it's somebody that, we've have in our network, and we've had a relationship with them for a couple of years, or they're somebody that we've already invested with personally ourselves. Mm-hmm. And so that's where really the relationship starts, is how do we know this person? What is their working style? Are they, do they have attention to detail? Are they, operating with integrity if something comes up? Well, how do they respond to that? Are they, thinking about investors first? Or are they thinking about themselves first? Are they really after just chasing the dollar, or is this a long-term business for them, right? So a lot of those things are the questions that we ask in the beginning about the potential partners. And if it's a partner that we think we want to work with, then we will, usually invest first and see if it's something that we want to, how that relationship plays out. So how are they updating us? Are they, are all of the renovations happening timely? Am I getting the returns I was supposed to get? So I think that's kind of what separates us from a lot of other groups out there, is that we really take the standpoint of, this is a partnership, let's do this together, and I can educate you because I've walked in your shoes, and I still do walk in your shoes, and most of the deals we bring to the table, we are also investing in. So I think that's a little bit different. So instead of me saying, hey, I have this deal, do you want to invest in it? It's more of like, a partnership, and I come from a place of, here's what I think about the opportunity, and here's why I'm personally investing in it. Would you like to join me? And that's kind of always been the way we've looked at it. And then I would say, it kind of flows down from there in terms of looking at the deals. When you think about all the deals that every operator has to underwrite, and all the deals they have to put an offer in to get that one deal under contract. Sure. And then we get to sort of cherry pick across those deals, which ones are the ones that we actually want to do. We're actually bringing our investors sort of the cream of the crop, so to speak, in terms of investment opportunities, because we're able to sort of pick which deals we want to do and which ones we don't want to do. Right. And so in terms of, the deals and what we're looking for, we're really looking for deals that are in solid markets, either markets like DFW that has seen a lot of strong job growth, or markets that are sort of emerging. And we have a couple of deals in markets like that, that's more of like an emerging market. And, we're really looking for deals that have a strong cash flow from day one. So we're not looking for anything that, doesn't pay out for 6 to 12 months. We like to see deals that have nice long-term debt on the property. And then we also like to see deals where we're going in over-capitalized. So you don't want to go into a deal under-capitalized, because, that could cause potentially a lot of problems down the road if, 6 to 12 months we get into a correction or a recession, which we all know is coming soon. We just don't know how soon. So I would say those are kind of like our top 3 things that we look for in any deals that we do. But yeah, that's kind of high level what we look for in terms of operators and deals.
That's awesome. So end-to-end process then there, Annie, would be is that someone contacts you, you basically self-educate them, or you provide them resources, and then as they are going through their process, that they have the confidence you then basically bring them the opportunity. So Julie, from a perspective of returns, give us an overview of like what typically you give guidance to your investors. And I say guidance only because we cannot guarantee or promise some things. We can only state that based on our history and the projections we are looking, here is what we think is kind of the profile of what we should expect. Could you maybe give us an overview of when someone, let's say, wants to invest 50,000, 100,000 of their hard-earned money, what sort of returns they can expect and blossom after, let's say, 3 to 5 years?
Mm-hmm. Yeah, so generally what we look for is an 8% preferred return. So that's standard in the industry, is something called an 8% preferred return or preferred return. And I would say 8% is usually the standard number that you'll see. We prefer those deals over the other deals where some operators will structure it where it's an 80-20 split, meaning 80% goes to the passive investors and 20% goes to the general partnership. And I think mainly it's because, we feel that there's an alignment of interest that way, right? If you've got an 8% preferred return, essentially the preferred return means that the passive investors will take the cash flow from the property up to 8% first before the GP takes anything. In an 80-20 scenario, they're just taking their 20% and you get the 80%. So a little bit different. And so 8% preferred return. At the end of every 12 months, we look to see, was there additional cash flow above the 8% that was paid to the passive investors? And if there was, then it'll split. And that changes from deal to deal and operator to operator. But I would say usually the standard is a 70-30 split, and 70% to the passive investors and 30% to the general partnership. So what I've seen in all of the deals that I've participated in and deals that we've done is it usually varies anywhere from the 8% kind of being the bottom and 10% kind of being the top. So you can get anywhere up to an additional 2% at the end of every 12 months cycle.
Awesome.
And then so taxes is another thing, which I think we'll talk a little bit about later, the tax benefits there. But the equity on the back end, let's say you invested $100,000. When we sell the property, you would get that $100,000 back in addition to equity. So just like if you were to buy a single family home, you bought it for $500,000 and you sold it for $750,000, that $250,000 spread is the equity. And that's how we're able to not only return the initial investment, but also return that extra equity on the back end. Sure. And usually that number is about $50,000 to $60,000. So you would get your $100,000 you invested plus another $50,000 to $60,000. If you were to take that $50,000 and divide it by the 5-year hold, that would be roughly about $10,000 a year. Sure. And so add that together with the cash flow annually that you received, you're essentially earning about a 20% return annually, or you can think about it as doubling your money. So if you invested $100,000, you would get your $100,000 plus another $100,000, between half coming from cash flow and half coming from equity.
That's awesome. And we don't know any of a bank product or a CD that can match those returns. Would that be right?
That's right.
And just for our investors, listeners who may be listening to this, preferred return is a concept where before any of the proceeds are given out, the investors are rewarded with that 8% right off the top. Is that correct there, Julie?
Yes, that's right. And I would say that money comes from the cash flow from the property. So it doesn't mean that the general partnership isn't paid anything prior to that. It just means that from the cash flow from the property, the limited partners get paid first.
Absolutely. And that's how the alignment of interest that we mentioned is that the operators are such that they're making sure that passive investors are rewarded. And that's the term, that alignment of interest is that the investors who would have invested, their interests are kept ahead of the actual sponsor who has done the deal. So good, awesome. Thank you. So now as we continue into this, you alluded there, Julie, about the tax benefits. Give us an overview of what sort of tax benefits are available to passive investors. Like, so they are into this deal, but let's say they invested 50,000, 100,000. Give us an overview of what they can expect at the year end through their statements.
Mm-hmm. So at the end of, well, not at the end, but every March of every year, you would receive something called a K1, and that's essentially a partnership statement.
Sure.
And that partnership statement will essentially, in the early years of owning anyway, will probably show a pretty hefty paper loss. And the reason we call it a paper loss is because it's going to show on the K1 that you lost money, but actually all year you cash flowed and you received that 8 to 10%.
Right.
And the reason that that paper loss is so big is because of two things. And the first thing is something called cost segregation. And so that's a study that a lot of operators can do on a property that allows them to accelerate the depreciation into the early years of owning the property.
Right.
And so, you know, that's one way, is the cost segregation. And when you think about the cost to do that on an apartment building varies, but I would say it's anywhere from 5 to 15,000 on up to 20,000. It really depends on the deal size.
Sure.
And who you're working with. But when you think about the cost that it costs the operators to do that versus the potential, you know, return, it makes a lot of sense, right? So everything is always,
Absolutely.
how much can we put into this, and what is the exponential reward on the back end for either ourselves and or our investors, right? And so that's something that a lot of operators will do. And then the second thing is the bonus depreciation that came into effect in 2017. So as of, I believe it was September 27th of 2017, operators were allowed to take a 100% bonus depreciation. And because of those two things, you would see, I mean, I have a deal that we closed, I think, in December of 2017. And so we literally only owned the property for 30 days. And that following March, our investors, let's say you invested $100,000, our investors received a K1 in March that showed that they lost $50,000 on paper, right? So not a bad loss for owning a property for 30 days. Now, I'm not a CPA, so I do have to make that disclaimer that you would need to check with your CPA on how that affects your taxes, because that varies in terms of, you know, your income level, how you classify yourself, and a number of other things in terms of whether you're actually able to take that entire loss against your income today, or if it's something that has to be held until future years. So, yeah.
That's awesome. So just to kind of bring this in full circle, so when someone invests, let's say $100,000, they are getting those monthly cash flow, or we can say dividends in a stock, you know, in a stock lingo, right? So they're getting the dividends at the year end, which is, you know, March financial year end. You're getting these K1 statements that are sort of showing that paper loss through a cost segregation study at the asset, that this is how much loss they made, and that you can write it off on your tax papers. So that's your second source of benefit. And the biggest bang for buck, as you indicated there, Julie, is that when these deals are sold at a higher value, potentially by through, you know, we'll get into it as to, you know, how the value add and things work. But the biggest bang for buck comes in wherein the property is sold, you have your equity stake still maintained. So you're getting not only a principal investment, but you're getting that additional return as well. And when you combine that from experiences of all of us, that we know that there are many places where people have doubled their money within maybe 3 to 5 years. I know cases where, you know, they have gone like 2.5 times, I should say, that you could invest 100,000 and probably get back 250,000, 230,000, depending on the deal size. Is that right?
That's correct. Yep. Mm-hmm.
That's awesome. That's awesome. So on an ongoing basis, what sort of activities are involved? Let's say you have invested, passive investors have invested with your company. What sort of activities or communications and things like that you're doing for your investors as the you know, as the activity and the asset is getting managed through the lifetime?
Mm-hmm. Yeah. So we're giving them monthly updates. So they get an update on, you know, when we close the property. Well, let me back up. So they'll get an email confirmation once they fund. So that's kind of the first thing. So after they sign what's called a PPM, which are the legal documents, and then they fund, then they would get an email from us saying, you know, we've received your investment, and there's kind of a certificate letter there. Then they would get an email on the day we close, and then they would get monthly updates thereafter. And And then every quarter, we also include links to the profit and loss statements and the rent roll, so that there's, full transparency. They are, even though they're passive, they are partners in the deal, so it gives them the opportunity to review the financials there if they wish. Those financials are always available. It's just that we automatically include links to those, every quarter. And that's pretty much it. And in the email communication that comes out monthly, we usually highlight, where we're at with occupancy. That's obviously a big concern. And whether or not we're meeting or exceeding the projected rental income that we had discussed, when we put the deal out to them. So if we projected $129 rental premium, are we meeting that, or, across all of our newly renovated units, or are we not? Another thing that we'll update folks on is the construction aspect. So, the value add, as we kind of touched on briefly,
Sure.
Any construction that's going on will include photos of all of that and kind of just update them. And any marketing efforts or news, in the local submarket will include that as well. And that's pretty much it.
That's awesome. That's awesome. And now, speaking about capital raising, how are you finding the investors? Like, what sort of sources you're using to, locate or educate people and things like that? What sort of networking you're doing for that?
Yeah, so when we first started, I would say a lot of our investors came from friends and family, just organically through conversations that we were having. And then over time, as we started to build out our online presence and build out our online resources and educational materials, then we started to see more and more people from online leads. And so nowadays, I think it's a good mix. We're fortunate that we have a lot of repeat investors. So people, maybe they were friends and family and invested with us early on, and then liked it so much they continued to invest with us. But we also have a number of new leads every day. Some from signing up for we have a free online course. It's an email course that just gives people a basic understanding of what passive investing and what real estate syndications are all about. So we have a number of people who sign up for that. And then we do a number of online marketing things, and we also use Facebook to find some leads through adding value to various Facebook groups and Facebook conversations. And then, of course, in-person networking through local and regional and events and conferences.
That's awesome. That's awesome. And a couple of last questions there, Julie and Annie. What sort of activities you are looking forward to now? Like, I know there's just so many deals, so many operators out there. What sort of keeps you excited and, moving forward in this space?
Vacation.
How about you, Julie? What's your big why about that?
Yeah, I mean, really for us, I think in all seriousness, for us, it's, and this has always been for us from day one, is to have an impact on people and family and the lives of people. So for us, what we do in terms of real estate investing is more of just a vehicle. It's not really, I'm very passionate about real estate and real estate investing, but what really excites me and what I'm really passionate about is not real estate investing specifically, but about the opportunities that real estate investing offers people and in terms of freedom. And I think at the end of the day, for us, what really makes us excited is when we realize the impact, that we're having on the people that we come into contact with. And that's what, moving forward, I would say, a goal of ours is, we often get asked the question, well, how many deals do you think you'll do this year? Or how much can you raise? And this kind of thing. But for us, that's not really the goal. And that's not really the question. For us, it's, how many lives can we have an impact on? And so, looking forward, I think that's our overarching goal, is to just continue to have the positive impact on people's lives and continue to invest for good. That's what we do. So
absolutely. I agree with you. And one of the interesting facets in all this also, Julie, is that all of our lives are professionally so busy. And as you can, pretty much relate that, raising family, kids in the context of, corporate job, your work pressure and things like that. There's just so many things going on in a family nowadays that it's very difficult to kind of keep your head out and say that, okay, you know what, I'm going to raise my head, drive 20 miles differently to look at a rental property, or perhaps, if you're fearless enough, go out and invest that money, come to find out it doesn't work. So your work as educating the investors and giving them these opportunities is exactly, I think, what a lot of operators should be doing, is that educating people and making them confident as to why this investment is important. And as you rightfully stated, that once they learn the impact that this can create financially on their young families, it's I cannot emphasize enough that how important this is, that people should take advantage and grow their nest egg. And I love your company's name, Goodegg Investments. That's exactly how it is. You grow your good egg into something bigger. So it's been a pleasure having you. Please share with us, Annie and Julie, like how more and more people can get in touch with you.
The best place to learn about us is to go to our website. It's goodegginvestments.com. And if you ever want to reach out to either of us, you can reach out to us directly at Annie at goodegginvestments.com or Julie at goodegginvestments.com.
That's awesome. That's awesome. And with us, we also bring in valued guests at Premium Cashflow podcast, experts like Julie and Annie here. We also have research articles, lots of statistics, podcasts such as this. And time to time, we always have a lot of good opportunities for investments that are available for accredited investors. So do ping us if that's of any interest. So it's been a pleasure having you, Julie. Thank you for your time, and Annie. And I look forward to maybe touching base, probably in coming few months as to what news are happening at Goodegg Investments. Thank you for your time.
Thank you.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.